I read an article an opinion piece that you wrote, talking about the risk perception of Africa compared to developed markets. I thought it was quite interesting, the points you point out there. Can you just share your argument with us?
Sure. Firstly, glad to be here. Quick anecdote, right? So if you look at what's going on globally today, is there more political risk in Africa than there is in the US? Is there more political certainty? Are people clear on what is likely to happen? Africa versus US, pick a country, right? And so that's sort of a starting point. I think the bigger point that we try to make is that investors' perceptions of risk in Africa are largely significantly outdated relative to what the reality is today, whether it's political or it's economic, rule of law, etc. And you could tell because the large multinationals that have been doing business in Africa for a while have, generally speaking, expanded their exposure to Africa. And if you look at COVID, they were deploying, Coca-Cola was deploying significant capital in Africa, etc. That's a reflection of real risk perception on the ground because they are operating there. So I think as investors adjust that perspective, as they look closer, they will find that the relative risk has shifted in their favor, and that shift has not yet been priced into assets. Assets are still cheap relative to what the reality is today.
Do you think that is across the board that we're seeing assets underpriced?
I think that is in the major economies. So if you're investing in Nigeria or Ghana or in Egypt, South Africa, or Tanzania, etc., the assets are going to be, generally speaking, better priced relative to one's perception of risk.
Let's talk about some of the clients that Sango Capital has. Sovereign wealth funds, pension funds, endowments. That's quite a long list of different forms of clients who you're advising. What are some of the questions that they're asking you? Is it still about risk right now, or is it a bit more nuanced?
No. So we took on our first U.S. institutional clients, some endowments and foundations, gosh, maybe 14 years ago. Before we took them on, they had questions about risk. We had them travel with us into Africa and see for themselves, and they all committed capital into our early funds. Today, I think the questions they're asking about Africa are much more nuanced. They've traveled, they've seen what's possible. For the longest time, they had questions around currency risk. That was the big risk. That shifted over the last 18 months. All the major currencies have been floated or repriced. And so a lot of economies are repriced. Those currencies are market rate determined. And so that risk is sort of subsided. I think the questions they ask now is, where can I find a good manager who can deliver the returns I want? What's a good management team look like? What are the challenges of a management team operating in Morocco versus Tanzania? How should I think about that? And so those are much more action-oriented questions.
How do you approach them then? And how does that affect where you're investing and where you're putting your efforts?
Okay. So I think first off, you have to pick a set of countries you want to focus on. There's 54 countries in Africa. You can't do everything. We focus on 8. And so 2 in each of East, West, South, North. And so we zoom in on those countries. We understand what is going on in those markets, what drives investor behavior, portfolio company behavior, opportunity set. So just to give you one example. We invest in retail as a sector, one of the sectors we focus on. If you look at how much consumer demand exists for retail in Africa, it's very significant. If you look at retail penetration, it is below 40% in Egypt, and it's less than 5% in Nigeria. Those two economies together are close to $1 trillion. How is it that people with money can't find organized retail to buy stuff? Okay, so if you zoom in on the countries, it helps you better understand the risk, and I think puts you in a better place to find opportunities that make sense.
So it's being selective, not just about the sectors, it's about the markets.
Absolutely.
Would you say it's just those, or is it even deeper than that?
The markets, the sectors, the counterparties.
The counterparties.
Who are you doing business with? How well do you know them? Do you trust them? Are they institutional enough in their mindset? Right? Are they aligned with you in terms of what you're trying to accomplish or not? I think those types of questions become very critical, because at the end of the day, this is still it's an emerging market. And so if you're, when I invested in my past in, let's say, Asia or Eastern Europe, same set of questions. You have to ask those questions. And increasingly, I find in developed markets, you still have to ask those questions, right? And so I think if you get from country to sector to counterparty, then you are making significant headway in addressing the risk question and also in identifying opportunities that make sense.
You talk about retail, and I wonder if you've seen similar growth trends that we've seen globally. So there's AI, right, as well, which is the big trade right now. Healthcare. Are those trends still following the same path that we're seeing globally across the African continent and where you're investing?
Yes, they're just differentiated by country. So I'll give you a simple example. Take pharmacies. So if you're watching this and you're from the US, you'll understand CVS, Walgreens. Those have been around for a long time. If you're in the UK, it's Boots or equivalent of sort of Boots. Okay, so a lot of African cities are places where they need a CVS or a Boots. Mm-hmm. Okay, so we invested in the first kind of CVS or Boots in Kenya alongside the fund manager, 15 years ago. It was 2 stores. At that point, there was no CVS or Boots, so you couldn't just go to a brand name pharmacy. A couple months ago, that business was sold, so that fund sold it to another fund, and that fund grew that business to about 300 or 400 stores across the region. Okay, so that's starting to happen in Nigeria, and that's going to make its way across different economies as those customers ask for those things. So you will see that in things like pharmaceuticals, you'll see it in financial services, in credit. You are seeing the application of AI because the uptake of technology in Africa is very, very high, and you've got a young population very comfortable using technology, so you are seeing application of AI as well.
Where do you think the growth comes from next? Where's the next opportunity? Is it private credit, as you were mentioning there? Is it in the secondary markets? Where are you focused?
So I think if you're, for institutional investors, there'll definitely be growth in private credit. So today, Africa's domestic credit to GDP is roughly 30%. Just to compare that to, let's say, Brazil. Brazil, the real economy of Brazil is less than half the size of Africa. Brazil's credit to the size of its economy is 75%. The US is 250%. So you can see there's lots of headroom for private credit. And today, that private credit is being provided in a very unorganized fashion by people who have money lending to others at
globally, you're saying?
rates. No, just in Africa, in an African context. So what you're starting to see is the emergence of private credit funds that are institutional, that take money in and invest and can generate the types of returns that compete globally. So private credit's one. Private equity in Africa has been around for over 40 years, but you went through a period of significant underperformance and lots of assets that were not sold. A lot of those assets are coming to market or have been coming to market, and so there's an emerging secondaries opportunity. Secondaries opportunity for limited partnership interests, very attractive right now, place we're spending a lot of time on. But even secondary direct opportunities, you're going to see a lot of transacting in that space for investors.
And finally, Richard, what would you say is the biggest risk right now if we take a look at maybe the macro picture? Do you focus in on that and what we're seeing in some of the developed markets and potentially how that will affect FDI and investment into some of these markets?
So the great thing about being an ignored market is when the world is difficult in lots of other places, it's actually great to be an ignored market. So Africa, for the longest time, has been a, generally speaking, ignored market for investors. People just don't pay attention. So as a result, it is generally disconnected from what's going on globally. So if you look at what has happened with tariffs in the US, the impact on Africa has been, in my view, de minimis for most countries. If you look at, in fact, for a lot of countries, it has forced them to be much more front-footed about the Africa trade, the new trade agreement that's been in place. Right. A lot of countries are stepping into that. If you look at currencies are floated, so that sort of link has weakened significantly. If you look at commodities, a lot of economies went through pain. They started to diversify away from commodities, so that's less of an issue. So today, I think, to me, Africa offers a very unique source of diversification for investors because you do not have single factor risk driving it. It's not a Fed issue, it's not a currency issue, it's not a commodity issue. And so you can pick up return with diversification.